Muhammad and Daniel. So I'm going to briefly explain about the background of both of our company. So the first company is AEON, which is one of the largest retail companies. It originated in Japan and entered the Malaysian market in 1984 under the name of Jaya Jusco, before being rebranded as AEON in 2012. So today, AEON operates as supermarkets, department stores, shopping malls, and also specialty stores across Malaysia. Meanwhile, PARKSON Holdings Berhad is a Malaysian department store company founded in 1987. It is part of the Lion Group and offers fashion, cosmetics, homeware, and also lifestyle products. PARKSON has expanded its operation to several Asian countries, including China, Vietnam, and also Indonesia.
So, for the first part is current ratio. The current ratio measures a company's ability to meet its short-term liabilities using its current assets. For AEON, the current ratio increased from 0.35 in 2020 to 0.51 in 2021. This upward trend indicates an improvement in the company's liquidity position. It suggests that AEON became more capable of meeting its short-term obligations and managing its working capital more effectively. In contrast, PARKSON Holdings Berhad's current ratio decreased from 0.89 in 2020 to 0.6 in 2021, indicate weaker liquidity performance during the period. Although PARKSON maintained a higher current ratio than AEON in both years. Although PARKSON maintained a higher current ratio than AEON in both years, AEON demonstrated a positive improving trend, while PARKSON experienced a decline in its short-term financial position. In conclusion, AEON showed an improvement in liquidity performance, where PARKSON records a declining trend despite maintaining a higher current ratio overall. Next part is quick ratio. The quick ratio measures a company's ability to pay short-term liabilities using its most liquid assets, excluding inventory. AEON's quick ratio increased from 0.08 in 2020 to 0.68 in 2021. This improvement indicates that AEON strengthened its immediate liquidity position and became less dependent on inventory to settle short-term obligations. Meanwhile, PARKSON's quick ratio declined from 0.73 in 2020 to 0.5 in 2021, suggesting a reduction in its ability to meet its short-term liabilities using highly liquid assets. Although PARKSON consistently record a higher quick ratio than AEON, AEON demonstrates a more positive trend over the 2-year period. In conclusion, PARKSON maintained stronger immediate liquidity overall, while AEON showed continuous improvement in its quick ratio performance. For the last part is net working capital. Net working capital measures the difference between current assets and current liabilities and reflects a company's short-term financial health. AEON's net working capital improved from negative 1.52 million in 2020 to negative 921,000 in 2021. Although the figure remained negative, the improvement indicates that AEON strengthened its liquidity position and enhanced its ability to manage short-term obligations. In the other hand, PARKSON's net working capital show that negative 373,000 in 2020 to 1.49 million in 2021. This suggests that current liabilities increase faster than its current assets. Although both companies report negative net working capital during the period, AEON show a more favorable trend compared to PARKSON. In conclusion, AEON demonstrate an improving short-term financial position, while PARKSON experienced a significant decline in net working capital.
Next is the account receivable turnover ratio, which measures how efficiently a company collects payment from customers. So for AEON, the ratio decreased from 40.91 times in 2020 to 27.74 times in 2021. This indicates that AEON became slightly less efficient in collecting receivable as customers took longer to make payments. On the other hand, PARKSON improved its ratio from 7.84 times in 2020 to 9.73 times in 2021. This shows that PARKSON became more effective in collecting debts from customers. Although AEON experienced a decline, its ratio remained significantly higher than PARKSON in both years. Therefore, AEON was still more efficient overall in converting credit sales into cash, while PARKSON showed positive improvement in collection performance.
Next is the average collection period, where it is used to measure the average number of days it takes for both companies to collect payments from customer after sale has been made, which is credit sale. So as we can see from the table and chart, the collection period for AEON company has increased from approximately 9 days to 13 days. This increase in trend indicates that AEON took longer to collect payments from customer in 2021 compared to 2020. Meanwhile, PARKSON showed a decrease in the number of days it took to collect credit sale, which is approximately from 46 days to 37 days. Even though PARKSON showed an improvement in 2021 by lowering its average collection period, it still took 3 times longer than AEON to collect payments from customers. So, AEON is more effective in collecting debts from customers. Next one is the average payment period, where it calculates numbers of days it takes for both companies to pay credit purchase to supplier. So, the longer number of days taken to pay credit purchase to supplier, the better, as it reflects the availability of cash in the company. As for AEON, the average payment period has increased from 165 days in 2020 to 194 days in 2021. It means AEON took longer to pay their supplier, and this was likely a strategy to preserve cash during the COVID-19 pandemic. Meanwhile, PARKSON average payment period decreased from 262 days to 206 days, showing that they pay suppliers more quickly as business conditions improve. Overall, PARKSON had a higher average payment period compared to AEON. Therefore, PARKSON reflect a good availability of cash in the company since they took longer to pay credit purchase to suppliers. Let's move on to inventory turnover ratio, where the higher inventory turnover indicates that the company is effectively generating sales using their inventory. So as we can see on the graph, it shows that AEON inventory turnover has dropped from 3.97 times in 2020 to 3.63 times in 2021. This shows that their inventory is moving slower due to COVID-19 pandemic that decreased the demand of consumer and disrupt the purchasing behavior. On the other hand, PARKSON inventory turnover increased drastically from 4.48 times to 6.55 in 2021 as the pandemic restriction lifted. This shows that PARKSON has improved their inventory management to generate more sales compared to AEON. Next one is the fixed asset turnover ratio, where it determines how well these companies can generate sales only from their fixed asset. If the fixed asset turnover ratio is high, this means that the company is more efficient in using their fixed asset to generate sales. So as for AEON, their fixed asset turnover has slightly declined from 1.2 to 1.17 times in 2021. This happened because their revenue fell by over 400 million ringgit while their fixed asset remained largely unchanged. However, PARKSON fixed asset turnover ratio increased from 1.5 to 2.28 times in 2021. This proved that PARKSON is keeping assets steady but spiked their revenue from 3.2 billion to 4.8 billion ringgit, which means they maximize their asset productivity. Therefore, by 2021, for every 1 ringgit invested in asset, AEON generated just 1 ringgit 70 cents in sales, while PARKSON generated a dominant 2 ringgit 28 cents, and it clearly shows that PARKSON is more efficient in using their fixed asset to generate sales.
For the last part is total asset turnover ratio. The total assets turnover ratio measures how efficiently a company uses its total assets to generate sales revenue. AEON's total assets turnover ratio decreased slightly from 0.66 in 2020 to 0.62 in 2021. This indicates that the company became slightly less efficient in utilizing its assets to generate sales. In comparison, PARKSON increased from 0.31 in 2020 to 0.5 in 2021, showing a significant improvement in assets utilization efficiency. Despite the decline, AEON maintained a higher total asset turnover ratio than PARKSON in both years, indicating stronger overall efficiency. However, PARKSON recorded a more positive trend by substantially improving its ratio during the period. In conclusion, AEON remained more efficient in generating sales from its assets, while PARKSON showed notable improvement in assets utilization over time.
Good afternoon everyone. So today I'm going to present the first part in liquidity ratio, which is the gross profit margin, which simply measures how much profit of a company keeps from its sales before other expenses are paid. During the pandemic, their strategies created completely opposite, which AEON margin actually improved, rising from 38.84% to 39.89%. Instead of panic slashing prices to clear the grocery and hypermarket shelves, they simply bought less new stock. By controlling their supply, they can protect their profit. Meanwhile, PARKSON margin dropped, falling from 50.24% to 47.84%. Because of this, PARKSON focused on high-end fashion, which their stock getting too old quickly. To get fast cash and clear out floor spaces, they launched aggressive deep discount clearance sales. Ultimately, this data highlights a classic retail trade-off. AEON chose to protect their profit margins, while PARKSON chose to sacrifice margin to get quickly cash flow. Both survived, but their financial playbooks were completely different. Next, I would like to present the net profit margin between AEON and PARKSON, which tell us exactly how much actual profit or loss of a company made after all expenses, salaries, and taxes were paid. While AEON and PARKSON both cut costs during the pandemic, AEON grew its existing profit while PARKSON focused on recovering from huge loss. AEON actually doubled its profit margins from 1.02% to 2.35% by strictly controlling operational costs, and even though total sales are dropped. Meanwhile, PARKSON made a massive turnaround, shrinking its painful negative margin from negative 19.29% to just negative 2.70%. They did this by dropping a bankrupt subsidiary, restructuring property, and heavily slashing expenses to get right to the edge of breaking even. Now, I will present the operating profit margin, which measures how efficiently a company runs its core rational operation by looking at the profit generated after paying for daily running costs, rent, and staff. During the crisis, both companies successfully improved their core retail efficiency, but AEON used minor refinement while PARKSON did a radical restructuring. AEON steadily grew its operating margin from 1.02% to 9.40% by tightening daily store spending and reducing staff to handle declining sales. Meanwhile, PARKSON operating margin jumped dramatically from 2.90% to 10.10%. They achieved this massive shift by attacking their biggest fixed costs directly, renegotiating high store rent and heavily slashing advertising budgets to build a high-efficient business. Next is return on asset, which measure how efficiently a company uses its balance sheet and physical assets like building and inventory to generate profit. During the crisis, both retailers successfully extracted better performance from their balance sheets, which AEON focusing on operational gains and PARKSON on asset cleanup. AEON doubled its ROA from 0.68% to 1.45% by strictly managing costs, allowing it to squeeze twice as much as profit from its existing stores and inventory despite lower foot traffic. Meanwhile, PARKSON reduced its negative ROA from negative 6% to negative 4.89%. They stabilized their heavily burdened balance sheet by undertaking a massive corporate restructuring and dropping the toxic bad debts of a bankrupt subsidiary to stop capital loss.
For Section 4.5, Return on Equity or ROE, it measures how efficiently a company uses the capital invested by shareholders to generate net profit. So for the trend analysis, we can see here that AEON showed an impressive upward trend, doubling its ROE from 2.38% in 2020 to 5.10% in 2021, driven by effective cost management. PARKSON remained in a net deficit but showed a steady recovery, narrowing its negative ROE from negative 4.95% to negative 4.55% as it focused on structural cleanup. So for the comparative analysis, AEON consistently outperformed PARKSON, proving to be far more efficient in its capital management. While AEON successfully created value for its shareholders, PARKSON faced higher structural vulnerability, spending this period focused on mitigating losses rather than achieving positive investment returns. I am now presenting Section 5.0, the leverage ratio analysis. These ratios are critical for understanding how AEON and PARKSON manage their debt and financial risks. So the first one is debt ratio. The debt ratio measures the portion of total assets financed by debt. So as we can see here, both companies show a positive deleveraging trend from 2020 to 2021. As we can see, AEON reduced its ratio from 72.58% to 70.27%, while PARKSON dropped significantly from 74.91% to 70.10%. It indicates a proactive approach to minimizing financial risk. So for the comparative analysis, we can see in 2020, PARKSON was more heavily leveraged at 74.9% compared to AEON 72.58%. However, by 2021, the companies structurally converged to similar levels, showing that both are now sharing an equilibrium in their capital structure. And the second one is debt to equity ratio. This ratio, it indicates the degree to which a company finances its operation through debt versus shareholder equity. So for the trend analysis, AEON successfully improved its financial stability by lowering its ratio from 2.65 to 2.36 times. PARKSON showed an even more impressive transformation with a massive drop from 2.98 to 2.34 times, effectively reducing its insolvency pressure. For the comparative analysis, in 2020, PARKSON was significantly more reliant on creditor funds, placing its higher structural risk compared to AEON. By 2021, PARKSON aggressive adjustment allowed it to align its capital structure with AEON, creating a safer baseline for stakeholders of both firms. The third one is times interest earned. This ratio evaluates a firm's capacity to pay interest expenses using its operating income. So for the trend analysis, we can see here that AEON showed steady improvement, increasing from 1.74 times to 2.01 times, demonstrating a better debt servicing capacity. PARKSON also improved, rising from 0.91 to 0.81 times, though it is important to note it still struggles to meet the ideal 1.0 benchmark. So for the comparative analysis, throughout the 2-year period, AEON remained the more financially stable firm, consistently maintaining the ability to cover interest payment from its store operation. While PARKSON made significant progress in operational efficiency, it remains riskier than AEON as it still relies partly on non-operating transactions to cover its interest costs.
In conclusion, both AEON and PARKSON faced challenges during COVID-19 pandemic. However, AEON demonstrated stronger overall financial performance throughout the period. AEON showed improvement in liquidity, profitability, and its ability to meet financial obligations. The company remained financially stable despite the challenging business environment. PARKSON, meanwhile, faced greater financial difficulties but managed to improve through restructuring, cost-cutting measures, and better debt management. These efforts helped to reduce financial risk and improve operational efficiency. Overall, AEON appeared to be the healthier and more sustainable company, while PARKSON showed strong potential for recovery and future growth. So that's all from us. Thank you so much.